So thank you very much for joining us to join this webinar organized by the OIBR Foundation, the Italian Foundation for Business Reporting, with the support of Horizon Capital, SGR, and the International Integrated Reporting Council. We are very happy you're with us. We're going to share nearly 2 hours of presentations and discussions around a topic that is emerging as more and more important, like ESG information chain down the investment chain. So I would start then the webinar using a few slides to help our discussion. 1 second, that of course the slides are not working right now. Of course, that is the obvious thing that should happen. Okay, so I think we can start now. We're just 1 minute late. All the speakers are lined up, so I think we can start now. So this is the agenda. We have a quite robust agenda with many partners and actors of the investment chain, describing what is their views today and tomorrow as well, of this relationship, information relationship between the various pieces of the puzzle, and of course very qualified persons that will provide us with their view of these issues. And of course we ask all the speakers to also tell us about the challenges they see they can have on their own, they can experiment in their own skin for when they address this issue or this information, ESG information issue. So first of all, let me immediately give the word to our president, the president of OIBR Foundation, Professor Alessandro Lai. Thank you for being with us, Alessandro, and describing what is OIBR.
Okay, thank you to you, Stefano, and thank you everybody for being here, and particular to Charles, that will be the next speaker. But I would like, if you are here, perhaps you already know about our foundation, and so I would like just to remind you something about that. And it's a legal multi-stakeholder entity that we founded last year, after a great experience we have about the new network of business reporting, which was founded in 2012. It's a body dealing with the elaboration, the dissemination, the willing to contribute to some extent to studies, researches, dissemination, to contribute to principle, to studies, to diffuse experience, with a technical and a practical orientation in the large field of business reporting. This large and new field, non-financial disclosure, sustainability, and especially integrated reporting, to which we are strictly closed, and also TSFD recommendation. And also it represents the Italian jurisdiction of the WICI Global Network. You don't know, perhaps, that we already have many stakeholders and many members, but what you don't know, even if you are here, is that you that you are listening to me now, you can become a member. And we would appreciate so much that, not because of the money that you will offer to us, is not for that, but for the contribution of idea, of experience, of network that we are able to form, to be close together. So I strongly encourage you to be part of our foundation. As we are an open foundation, we have a strange form that we are not a closed foundation. We are a market lead organization open to all the Italian stakeholders. So you can become a member of this foundation, both if as a person or as an institution, with your university, with your companies, with your institution, your organization, as single manager or as your organization. And so, as we are a non-profit entity with no commercial engagement, we would like to have you inside us. But while you are thinking about that, we can just say, I hope you to enjoy very much this webinar that has been composed through the effort of Horizon, Christina, and IIRC. And so I hope this webinar will be happy to be followed. I'm sure that will be constructive to know and to understand something new. It's with this spirit I give the voice to the president, to the CEO, that is much more. Stefano is much more than me. He's the CEO of this organization, and I give the word to the CEO of IIRC. Thank you very much for being here, everybody of you. Thank you.
Alexandra, thank you very much indeed. I very much appreciate the opportunity of speaking to the OIBR this afternoon. You've got a very exciting agenda, and it really is a pleasure to be speaking to you. Please, thank you. We are, if we can, thank you. If we can, we are an organisation that was formed in 2010. We're a coalition of global organisations, so organisations such as the World Business Council for Sustainable Development, IOSCO, the World Bank, and many others. And then investors, corporates, and obviously the accounting profession, and I see this very much as being everything that we're doing is, if you like, the future of the accounting profession, and as well, obviously, organisations, NGOs and so forth. You can see here, for instance, Transparency International and the importance of building trust at the present time. So a lot of important organisations within our coalition. And the reason we were formed was very much about a clear need for the development of corporate reporting. And so moving on to the next slide, there is an undoubted need for that change. What we've got here is a chart which I'm sure many of you are familiar with, just demonstrating that today, if you've got a company which is worth a billion lira, then 900 million of that lira is going to be in intellectual capital and doesn't sit on the balance sheet of the company. So, an extraordinary level of change over less than 50 years. And what I can see is this is just going to continue for the foreseeable future, where the value is not sitting on the balance sheet, and hence the need for that integrated reporting. So just moving on, in September, 5 organisations, us as a framework setter, the IRC, together with GRI, SASB, CDP, CDSB, all sustainability standards organisations, produced a statement of intent. And this particular chart, I think, is very, very important in terms of setting out the role of the frameworks and standards in terms of the overall corporate reporting system, both from an information producer's perspective and an information user's perspective. What you can see here is that it underpins absolutely everything, and in particular from the user's perspective, and in particular the end users and the regulators. So it's really important, and if we get them right, it builds trust. It particularly does so if the reporting is also subject to assurance. So it's absolutely these frameworks and standards are critical to the way reporting is undertaken and the value to the users. So moving on, and really what is at the heart of business, what is at the heart of the integrated reporting, the IRC's integrated reporting framework. It's value creation. And how is that value created? It's created through a company, an organization's business model. The first aspect for any board of directors is to understand their business model in detail and how they are creating value. But equally important is, what do they understand that external the environment in which they're operating, and as a consequence, how there are going to be opportunities and risks to their existing model going forward into the future. It's that external external environment that drives the change. And in the world that we're operating in today, a successful business is one which looks after its customers, it looks after its employees, it looks after its supply chain, it works well with the society in which it is operating. And therefore it has to have a multi-capital focus. And that multi-capital focus provides the resources for the activities, but they also need to be, those resources need to be looked after, shepherded, grown, so that they're available for the ongoing long-term success of the business. And it's therefore absolutely critical that the organization thinks about its business model and external environment, and how it tells its story and how it uses our framework, not just as a basis of reporting, but also as a governance framework, as a risk management framework, and also even going as far as, have they got the right information? So how do you manage your data in the first place? So the framework is not just multi-capital, it's also has a multi-use to it as well. Now, going back then to the statement of intent and this chart here, and our statement of intent, which was towards this comprehensive corporate reporting system. What the statement, I think, succinctly did was set out the role of the frameworks and standards, as I've already talked about. It talks about how they link together. It talks about the incredibly important topic of materiality. It positions integrated reporting as the, if you like, the roof on the house for the annual integrated report. But it also identifies areas where we have got to move forward into the future. And you'll see here that we're talking about comprehensive value creation, but actually value creation is not just the financial standards and the sustainability standards. That doesn't give you that comprehensive view about how an organization is creating value. We also need to think about manufactured capital and intellectual capital. Now, I mentioned that the really important topic is that topic of materiality. And what we've got here, I think, is basically that you've got the financial capital, which is, we know, and I think are very used to materiality in that concept. But if we're going to think about what is material to the wider value creation, then it's really important that we understand the external environment, and it's from that external environment that you can then filter what is material to the company in terms of how it allocates its resources, in terms of thinking about both taking advantage of opportunities and also in terms of mitigating risk. And we've got all of that considered in this report and summarized in this chart. So that's really all I wanted to say today. And just to conclude, we're talking about reporting which is relevant to today. We're talking about the fact that if we get reporting which is relevant today, it impacts the behaviors particularly the governance behaviours of the board. It identifies, for the companies that do it well, businesses which are a force for good, and they're driving value creation in terms of what is critical to, and thinking about what is critical to their long-term success. And that is, many people talk about, everything's in the, or have historically talked about everything being about financial reporting, but actually financial reporting is the outcome of being really thinking through what you need to do for your customers, what you need to do to attract the right employees, what you need to do to have a good supply chain which meets the needs of your customers with you, and also how you fit into the external environment and how you work with society. Those are all the value drivers, and that's what integrated reporting is about, and how you think about that is the integrated thinking element. So thank you very much indeed for the opportunity to talk to you today at the your OIBR conference. I hope it's a great success, and back to you, Stefano. Thank you very much indeed.
Thanks to you, Charles. And it's difficult to upload through the webinar, but thank you for this. In case if you have any questions, we can also have a final section on Q&A, or in case we can let Charles have your questions, afterwards off webinar. Thank you for this. So this is a very good introduction about what is the relevant information, what is the material information for investors. So let me just take 5 minutes, less than 5 minutes probably, to do some introductory remarks on the basis of what Alessandro and Charles just explained, i.e. the fact that we live in a complex and a world that is more and more in a stronger evolution. And so we should pose ourselves the question, what is a relevant information? And in the last few years, European Union and of course European Commission tried to help an evolution in the information, in the corporate information environment. And in particular, as you can see, this evolution has been so rapid, almost frantic, because the regulatory framework for transparency, ESG accountability of investors and of companies, of course, and also their decision-making has become more and more complex. And it really, when I was, drawing up this slide and I was start writing the various acts, directives, regulations, delegated acts that are happening in the last few years, I was impressed by myself in a sense that it was such a long list, starting from, you remember the non-financial reporting directive number 95, 2014, but from that moment on, there's been an incredible accelerated pace at which, the European Union started off with new initiatives, and of course, sustainable finance, the Shareholder right directive number 2 in 2018, which is another important part, element of the puzzle. Sustainability related disclosures, a new regulation in 2019, the European Green Deal for the next probably 10, 15, 20 years for the European Union in December 2019. The green taxonomy, there has been, of course, lots of discussions about the green taxonomy, which is recent, it was June this year. And of course, there will be all the delegated acts on climate change mitigation under the green taxonomy. And just a couple of days ago, ESMA, the stock exchange regulator of the European markets, issued a consultation paper, quite technical, on KPIs that should be delivered by financial actors. So it is 5th November. Just to say that it's a very impressive list. Clearly, the regulatory framework is changing. And of course, all this is impacting on information that should be delivered by companies and should be used and also by investors. Furthermore, I'm very glad that Charles decided to stress that it's not enough. It's not ESG conceived in a very narrow sense, but also looking a little bit, raising the eyes for a moment. More and more investors would like to have information about intangibles for the simple reasons that Charles explained. That 80–90% of the values of the market value of companies made up of intangibles today, and we don't have enough information about intangibles financial statements. Also, very recently, important data emerged in Europe that in the response to the revision, in the response to the public consultation of the revision of the EU Directive of non-financial reporting, 59% of information users demand for more information from companies on their investments. So just to cut a long and complex story short, there's a clear emergence of a new dimension in the relationship between companies and investors, more and more stronger ESG and corporate information chain, linking up the various actors. And of course, it's fostered by new needs for transparencies and reporting, also by investors on their impact. So the reporting problem, the reporting issue is not just about, of course, corporate companies, has always been, but it's more and more also about investors. And the intertwining between these two sets of actors is, of course, very important, determines new challenges. A question naturally arises, which is a little bit the fil rouge of the whole webinar. Is corporate information appropriate, the corporate information transmitted appropriately through the investment chain in order to enable the appropriate decisions by investors? So is the ESG information widely conceived we have from companies the good ones? So in this respect, of course, this is the question, and we just give the word now to our speakers, which of course represent various actors, various pieces of this complex investment chain. It's a pleasure now to give the word to Dr. Marina Jodice, that is Senior Portfolio Manager for Impact Investing and Investment Partners. Investment Partners is a very important, a specialized company, investing company, working on the ESG, specialized in ESG. And of course, she has to deal with the problem of the information or ESG information every day for her work. So Marina, the floor is yours. Thank you for being here.
Thank you very much, Stefano. Pleasure to be here, everyone. So I will start sharing with you my presentation. And today, what I would like to do would be to give you a little bit more insight into what we as responsible investors do and what kind of information we look for exactly on the back of what's been discussed so far. I will present for about 13 minutes, open to a couple of questions, and then happy to take any further questions going forward. So this is a quick overview of what I'm going to explain. Let's start with giving you a little bit of a background of who is NN Investment Partners. So NNIP is a company that dates back the late 19th century. And today we manage over 280 billion of assets under management, of which over 2/3 has already embedded environmental, social, and governance ESG factors. And there's over 23 billion euros of assets under management that are specifically dedicated to impact and sustainable strategies. And the equity impact strategy represents about 2 billion in assets under management, which is the one that I represent with my colleagues. And so what we believe, our approach to responsible and impact investing in this specific case, is that we can achieve both social and environmental impact together with financial returns. But in order to make this bold statement, we need to prove to our investors that indeed the companies where we invest in have an impact. And therefore we need to quantify and then monitor this impact. In order to do so, we have created our impact investment funds. We today have a global strategy and as well as 3 thematic impact strategies that focus on 3 themes: people, planet, and prosperity. And each team has a different set of solutions which address specific types of SDGs. For those of you who are less familiar with the SDGs are the Sustainable Development Goals, and they were introduced by the United Nations in 2015 in order to basically approach North and South and provide more of an homogeneous respective understanding and moving forward for the planet as a whole towards the addressing some of the most important challenges that we have. And as you can see, an example of how we make the approach, the relationship between these SDGs and investment solutions that we look for. We, for instance, under the theme of the planet, we identified 4 solutions: water management, food efficiency, energy transition, and circular economy. These solutions correspond to different sectors. And every one of these sectors then will have a natural exposure to certain specific SDG targets, because the UN didn't only provide SDGs goals, but they also provided us with targets that enable us to better measure what we're looking for. Some of the things we look for instance, are improved water quality. Others are increased agricultural productivity, double energy efficiency, prevent, reduce, and recycle wastewater, among others. So how can we make this link? But we created our own reporting framework, and we created our own reporting framework because today there's no standardized methodology for how investors should report. But as you will see later in the presentation, and as has been discussed before, regulation is increasing, and therefore we may move towards a unified direction. But so far today, what we have is that we try to understand how companies are moving towards the journey and how we can possibly measure their achievements. So first, we identify the impact potential of the companies, the activities and the reach that they have, and then we want to understand how they make an impact. So first, we want to understand what kind of positive impact they can provide, and also what are the ESG risks that they are exposed to. We're identifying the key KPIs. And finally, we want to measure their progress, and this is where the reporting comes in place. And we also want to engage with them to understand how they're moving towards the sustainability journey, as well as their disclosure journey. Today, though, companies report in a very different manner. Here, for instance, you can see a couple of examples of companies that are particularly transparent about their positive impacts on society, but they reported in a completely different way. On the left-hand side, you have Christian Hansen, a leading bioscience company that has estimated the revenues from their activities that correspond to specific SDGs. On the one hand, sustainable agriculture, healthier and safer pets, and reducing waste and increasing productivity. So 3 completely different SDGs. We have a quantification of revenues, which is also verified by third party. On the other hand, there's a mobile operator in Kenya, Safaricom, which also made a very interesting, though quite different exercise, which was the one of providing us with qualitative understanding of how they contribute to Kenyan society, because they enable digital payments and therefore they facilitate financial inclusion and access to basic needs. They increase demand for utilities created jobs, and they also allow more personal savings by reaching overall 35 million customers in Africa. So they estimated that the overall positive impact on the Kenyan community was valued at almost 10 times as much as their profit. But this is the data provided by the company. And as much as it is valuable to us, we cannot compare it to what other companies provide. So you can see here that there's quite a discrepancy in the information that is provided by the companies. And this is why we believe that it is important indeed to engage with the companies, because engagement aims to encourage responsible capital allocation, but it also gives us the oversight of the company's ESG, environmental, social, and governance risks, and encourages improvement. And in particular, when we engage with the companies, we monitor whether they are also improving their practices as well as their reporting, because many companies have great positive impacts, but they don't really report on those. For instance, there is a solar inverter company, the company that we are invested in, that is called SolarEdge. And this company, we have spoken and engaged with this company for about 6 occasions over the last 12 months, because generally we speak to a company at least once a year. Some companies we speak to them much more because they're probably more important in our portfolio. This company provided quantification of their positive impact, for instance, by stating that they shipped 16.2 gigawatts of renewable energy worldwide, and they provided us also the corresponding CO2 emissions reduction related to it. However, although they had the sustainability reports, they didn't really disclose things that we still deem important, such as their own CO2 footprint. And CO2 footprint also calculated on the basis of scope 1, 2, and 3. But in our exchange, we understand the company is already doing a lot about that. It's just that they haven't gone there yet in terms of providing a transparent and clear reporting. And therefore, we're still monitoring to see how they would progress towards it. This is a long journey, but it's also one that is very interesting because it really allows us to see how companies progress over time. Now, as I was anticipating before, we believe that going forward, there will be increased regulation that will reorient private capital to more sustainable investing. And we've seen, as Stefano mentioned before, that there's a number of initiatives that are coming up. I just summarized a few of the key ones here. Some are more relevant for companies, others are more relevant for investors. Bottom line, they will all impact us in the same way because they need more transparency. So we as investors, we are preparing for a multitude of upcoming regulations. Some will already kick in March 2021, so in a few months. At the moment, these are just regulations and there's no much guidance around implementation. Our primary focus at the moment is with the Sustainable Finance Disclosure Regulation, which demands for more transparency for investors, and therefore we will need companies to provide more transparency to us. But the objective of the regulator at the end of the day is to create standards and labels that define green products and their content, with the aim of providing greater clarity and comparability. So the purpose is very noble and very, very exciting at the same way. However, it's also very challenging because, as you've just seen, and as you probably know already, information is sparse and there's no clear methodology. So what do we need to get there? We need better, broader, and standardized information. Investors around the world have been already pressing companies to improve sustainability disclosure for years. But today we have several data providers and several initiatives that exist, but there's no commonly agreed framework or methodology yet. Sometimes, and here I'm talking about frameworks on one hand and methodology specifically because I'm referring on the one hand to the way companies should communicate, but also on which data they should communicate. And this has to do with the methodologies, and I'm thinking specifically about CO2 emissions, but there can also be others related to positive impacts on society. So bottom line, reporting on impact, because I am an impact investor and therefore I go a little bit beyond sustainability risks, reporting on impact is at an even earlier stage. We struggle to report impact performance of companies on an aggregate portfolio level because of lack of reporting and lacking of commonly agreed methodology. But we do believe that this will improve very fast. So to summarize, I think that companies should align their strategy to the Sustainable Development Goals, and that they should report both on their positive and negative impacts in a quantifiable manner. And the reporting initiatives should converge to one commonly accepted standardized framework that is both comparable across sectors and across company size. This is not easy, but it's definitely the way forward, in my view, to develop further transparency in the field. So with this, I conclude my presentation, and I'm happy to take any questions if we have time, but I think I just finished on time. Stefano.
You perfectly finish on time. Maybe we can have a few questions. I myself, I have a few questions, but let's stick to the time. Thank you very much, Marina Iodice, because we have two Marinas, you know, so this is Marina Iodice. Thank you very much for your very interesting presentation, challenges we have ahead of us. So now let's go back to my slides, and after Marina we have another Marina. As I said, this wasn't on purpose. Is Marina Pardini, Dr. Marina Pardini, from the Sustainable Investments and Engagement Lead at the Banco Posta Fondi SGR. Banco Posta is the largest investor probably in Italy, is the asset manager of Poste Italiane. And of course, they have a very privileged position to understand and to evaluate what's going on in terms of ESG information and information useful to investors. So Marina, thanks very much. The floor is yours. You don't use the slides, so please, you can go ahead whenever, any time from now.
Thank you, Stefano, and thank you for the opportunity of speaking in this panel. My name is Marina, so it's quite unusual for me to to be the second Marina. So I may refer to Marina, but it's not that I refer to myself in third party. I will refer to Marina Iodice. I work in a research team of that is the asset manager of Poste Italiane, as Stefano said, and we manage now approximately 100 billion euros, both retail funds and institutional mandates. And also another peculiarity is that these assets are managed by internal portfolio managers, but also by external delegated managers. So what I would refer to are challenges not only in analyzing issuers, but also in analyzing the performance of external managers and also of portfolio, as we also have third-party funds in our portfolios. In 2019, we joined the PRI, making a formal commitment to incorporate the ESG criteria in the investment process throughout all the investment process. And as an institutional investor, this has been felt as a duty of creating long-term value by managing the risks that we already know about ESG, but also the opportunities that are there to enhance sustainable finance. To address this commitment, this ambitious commitment, the SGR has adopted 3 formal policies. One related to the responsible investment in general, another one related to the sectors that are deemed controversial, and a third one related to stewardship. These policies are valid not only for the internal portfolio managers, but as I was referring before, also to externally managed portfolios. So I will try to respond today to 3 questions. How ESG data are used, who uses this data and within our organization, and which are the main challenges and opportunities that we are facing. To address this question, I think that it's better to break them down into 3 phases of this ideal flow of the ESG information supply chain. Because there is something that happens before the investment, thinking about it as an ideal phase, during the investment, and also after the investment. Starting with before the investment. Sorry. There are 2 strategies that we apply before the investment that are exclusion and ESG integration. These strategies are applied by gathering information from specialized data providers. And this means that we will gather information and then reassess them and send them to two actors that are fundamental for us: the risk managers, that will receive mainly the blacklist, so the issuers that need to be limited, so that the portfolio managers are not allowed anymore to invest on them, but also on the other hand to portfolio managers themselves, so that they have this piece of information, and they will also have an additional information, that is the ESG scores of issuers, so that they can better align their investments and to perform better in the ESG score at portfolio level. These, of course, these activities are facing big challenges, because as Marina was previously mentioning, data are still not as homogeneous as we would thought, and also they may not be comprehensive in terms of coverage, and also I would add they may not be user-friendly, because even if we take them from specialized data providers that are doing a fantastic job to aggregate them and make estimates for where there is no data, still they may rely on their own platform. So, and this platform may not be accessible to all our stakeholders, thinking about internal portfolio managers, risk managers, external portfolio managers. Each one of them have different valuation models, but also different tools. So this is also a very practical challenge. This may be faced and may get better, I think, with the implementation of the taxonomy. As Stefano was mentioning, there is a lot of regulation. This is a challenge too, but if I want thinking about it in a positive way, I think that the taxonomy on this issue may lead to more homogeneous assessment, as it's based on specific criteria that are set in a quite objective way for all the issuers. So it will be at least more homogeneous, the assessment in the future, from the perspective of what are the assessment from one data provider to another one, but also from one investment manager to another. There may be more commonalities in the future. Then another challenge that is very connected to this one for us is that there are the same issues that we are facing for ESG data at issuer level, at portfolio levels. So when we are looking at funds of third party, still there are very limited data providers that will assess the ESG performance of funds. And this may depend on several factors, not only on the limited coverage of issuers, but also on different methodology in aggregating this scores, and to the limited coverage related to the constituents of the funds themselves. That is also, there is also lack of information on that in some instances. This is also an area that will be addressed by regulation, because as we know, next year it will be there will be in March the entrance into force of the sustainability related disclosure regulation, and this will give more information on ESG performance at fund level. So we will face both a challenge on one side, because we will have to give more information, but on the other side we see that as a positive signal, because we will also gain more information in the analysis of the performance, the ESG performance of funds. Then I will move on to the second phase, that is what happens during the investment process. And this will relate to mainly two activities, one that is engagement and voting. For this, there are specific challenges, because when we engage with issuers, we are confronting to people that are working in that company, for instance. So they are the main expert, and it's difficult to go there with information that are at very high level and that may be not up to date, because we know that ESG data, also from specialized providers, may have a year, maybe a year old, may have delays, and because they rely mostly on sustainability reporting, or because they rely on estimates that are not done every day. So in these cases, we prefer to go deep dive and go to look at the direct communication of companies, and that's why it's important to look at non-financial disclosure of companies in these cases. And even there, I think that a very useful tool would be the online platform that I've heard that is under discussion now, at least at the European level, so that there will be a more standardized setting, and there will be an opportunity to have the information directly from issuers, at least a subset of this information that we now gather. When we talk about engagement and voting, it's important also to stress that there are information, ESG data, that will come from this activity too. So then there is also an internal flow to exchange and share this information that we gather from the dialogue with companies to the portfolio managers. And that's why we are also asking our external managers to share this information with us, so that we can unify the voice and strengthen also our influence to companies. In these regards, I will mention also the Shareholder Directive too, that will enhance transparency, and that will come handy for us to ask more information and common information from external managers. Finally, after the investment, so looking at the third phase, this ideal third phase, there is of course the need to monitor and report. The reporting and monitoring, it's not only for the internal stakeholders. We do have a managerial committee that is the ultimate responsible for taking the decision to whether start the engagement, continue the engagement, cease it, or even as a last result, divest if that is not successful, or if there are any other controversial risks that arise. But in this case, the information is also shared with the clients, and more information will need to be shared with the clients. So for instance, now an information that is shared only at the managerial committee level and internally with portfolio managers is the score of the funds. And this will entail not only the aggregate scores of the issuers, so the weighted average, let's say, of the issuers, but also the scores of the third-party funds or of exchange trading funds are also in there. And I think that what the regulation is pushing towards is also to have a similar ESG performance monitoring towards that is addressed to clients. And this was a challenge because this information are difficult to interpret from people that work in this field. And I've heard also participating to working groups looking at these directives and regulations, all the difficulties in understanding the requirements. So I cannot imagine the difficulty for clients to interpret the data. In this regard, I think that it's very important to set the limits of the data that we have and be transparent about the possible limitations. We will need to work on a best effort basis, but it will be definitely a way to be more accountable, and by being more transparent, we can also have occasion to deliver more education on these topics. Just a final, so I have concluded the flow of the information that we are facing as the ESG supply chain for us. But a general remark that I would like to make is that I found a striking resemblance of what we are facing now with human rights. I heard this in the human rights arena, that there is a need to move from integration to inclusion. And integration is referred to, for instance, in equal opportunities case, as having a group dedicated to minorities in the organization, while inclusion means that minorities will have the same access, the same rights, without the need to have this dedicated group. And that was striking for me, because I think that we are at the same similar turning point for ESG, in the sense that there is, of course, the need for dedicated professionals, but it needs to be not only topics segregated to this dedicated group, but more broadly addressed. Thank you.
Okay. Thank you, Marina. Very interesting presentation. Incidentally, on human rights, there will be very soon a new European directive on mandatory human rights and environmental supply chain disclosure. So that will be mandatory disclosure on human rights and environmental supply chain. So it's moving in that direction. Thank you very much for your wide picture of what you're doing in this respect. Sounds many inputs for our discussion and reflection. Let me move on. Thank you, Marina. Let me move on to Thomas Broderick. Thomas Broderick, that is the Vice President Asset Servicing of State Street Bank. State Street is a very famous institution, international institution. And we thank Thomas for being here with us. It's a great pleasure to have him on board. And of course, his perspective, we know that State Street is more an intermediary in the chain, and a very fundamental, crucial intermediary in the chain, especially as to the shareholder relationships with the companies and other actors in the investment chain. So they also occupy and play a very important role in the investment chain. So Tom, the floor is yours. Thank you again for being here.
All right, thank you, Stefano, for your very kind words. Once again, I'm Tom Broderick, and I have oversight of client service responsibilities within the asset servicing division at State Street, primarily focused on corporate action activity, shareholder meeting activity, and income. First of all, thank you all for providing me with the opportunity today to discuss State Street's role in implementing the Shareholder Rights Directive 2. We refer to it as SRD2, and to explain how we as global custodian have assisted the industry and our clients in benefiting from and meeting the requirements of the directive. As most of you are already aware, the Shareholder Rights Directive 2 went into effect on September 3rd, 2020. And one of the main objectives of the directive was to increase the transparency between security issuers who have their headquarters in the EU or in the European Economic Area and who shares trade on their local exchanges. Really, the goal was to increase communication between these parties, which in turn I believe should lead to improved corporate governance. As global custodian, we are just one of many intermediaries in a chain of parties who are responsible for relaying financial information from issuers to entitled investors of these impacted securities. For the purpose of my discussion today, the information I'm referring to relates to corporate actions, shareholder meetings or proxies, and dividend income activity. Our clients themselves may be deemed to be an end beneficiary or end holder of a security, or our clients may be considered an intermediary themselves, which I think is an important component because they too have underlying clients beneath them. And as an intermediary, they too need to meet the same obligations of the directive as State Street does as a custodian. We've identified several themes within the directive that really resonated with us and impacted our asset servicing functions and business operating models. These included the concept of notifying clients without delay, improved deadlines or enhanced instruction processing, providing additional beneficial ownership information or details about an issuer's underlying investors, and then the shareholder meeting vote confirmations. So these are four very important components to us. So the question is, how did we do this? So first, we needed to understand how member states of the EU were going to interpret the directive. Member states were mandated to transpose the directive into their national laws. Some member states may have interpreted the directive differently from others, so we needed to account for the variations across member states. We hired external counsel to interpret each market transposition to ensure we understood the market practice under those directives. Second, we needed to review all our current processes to make sure that we would meet the needs of the directive. If we didn't meet those needs, we needed to change them through technology enhancements or process changes. And thirdly, we needed to understand the impact to our clients. If our clients were the end beneficiary from an asset servicing perspective, there was little impact to them. But if they were an intermediary, we wanted to ensure that they were aware of the requirements mandated of them by the directive. In the States, we found that some of our clients were generally unaware of SRD2 as a directive that may impact them. So I think one of the important things about reaching out to our intermediary clients. As far as notifying our clients without delay, the directive states that notifications received prior to 4 p.m. local time had to be distributed that day. Information received after 4 p.m. Local time had to be delivered by 10 a.m. the following business morning. This applies to corporate events, so corporate actions, proxy, and income notifications. From a corporate action perspective, our standard for providing clients or their investment managers with event notifications was 24 hours. Clearly, this was not going to meet the needs of SRD2. To ensure our clients received timely notifications, we enhanced our follow the sun model across our global operating hubs by shifting market responsibilities. We transitioned functions and created a robust model for workload swap in cases where work was required to be transitioned in order to meet our notification timeliness requirements. With our annual SWIFT release scheduled for November 20th, we'll also incorporate an SRD2 indicator flag in our notifications that'll allow clients to understand if the underlying security on that notice falls under the SRD2 directive. From a proxy shareholder meeting perspective, most global custodians employ the use of a third-party vendor or service provider to communicate and process shareholder meeting notices and elections on our behalf. Under SRD2, notification requirements were the same as corporate actions, with issuing shareholder meeting announcements without delay. Pre-SRD2, we incorporated an end-of-day process to identify entitled clients in their holdings and would transmit this data to our vendors, which was used in the creation of the ballot and the shareholder meeting notice to clients or their vote agents. Once again, the timeliness of the notification would not meet the requirements of the directive. So to ensure the notifications would be distributed without delay, we engaged in system development to incorporate additional intraday files to identify holders quicker and to distribute pre-ballot notifications to them that met the timeliness requirement of the directive. We work with our vendors to ensure that they can consume and transmit new SWIFT messaging. Shareholder meetings and shareholder identification requests require 10.022 messaging, and that was considered the preferred communication method for shareholder meetings and shareholder IDs under the directive. From a dividend income perspective, our current process, which systemically validates dividend event information from 2 vendor sources, was not going to meet the directive, as it could often take more than 24 hours to match up and compare information from those providers. To provide a compliant notification, we developed and built a new notification report within our client portal that provides income-related information to our customers for their use. The report is updated twice daily as dividend information becomes available and announced by our local providers. From an improved deadline perspective, the directive mandates improved deadlines by which investors could submit their elections. You had varying market deadlines across the region. However, under the directive, the deadline to the end investor could be no greater than 3 business days from the market deadline. So that was a major change in the operating model that is being used today. And although we are compliant in the directive for our corporate action deadlines, we are currently enhancing our systems to reflect improved deadlines. And we're looking to incorporate a 24-hour response deadline for our customers and expect this enhancement next year. Our proxy vendors have also enhanced their systems to incorporate improved deadlines, providing investors with more time to make informed decisions. Depending on how a market transposed the directive into national law, intermediaries may also be required to submit elections to the next intermediary without delay. This provides issuers with a better sense as to investor and shareholder sentiment and participation in an event. Pre-SRD2, intermediaries or their agents may have held on to client elections, transmitting them closer to the next intermediary deadline. And as far as beneficial holder details, to improve transparency between the issuers and their investors, intermediaries are required to provide additional information to help issuers identify their investors. Today, you do have corporate action and proxy events in which the disclosure of beneficial owner information is required as a prerequisite for participating in the event. The directive requires that intermediaries provide more granular details such as legal entity name and number, BIC codes, taxpayer, employee identification numbers of investors, and also to designate whether, if it is a beneficiary holder, are they a natural person or a legal entity? And although not specifically part of this discussion, the same requirements are also mandated for shareholder identification requests from issuers or their agents. To accommodate the increased demand for information, State Street has enhanced our vote disclosure files with our vendors to incorporate all the mandatory fields required to process a client election. And then finally, vote confirmations. I feel this is one of the most beneficial aspects of the Shareholder Rights Directive. Having managed proxy processing for several companies in my career, clients would often ask how they'd know that their elections for a shareholder meeting were actually lodged and counted at the meeting. Absent some small pilot programs in the industry, vote confirmation was difficult to attain. The implementation of both a pre and post-meeting vote confirmation, I believe, provides increased transparency to the voting process and should increase confidence that shareholders do have the right to communicate with management of issuers and have a say in how the company should be run. In conclusion, one of the main objectives, as I previously stated, of the directive was to improve transparency and promote dialogue between security issuers and their investors. It's only been a little over 2 months since the directive took effect, and many intermediaries are in various stages of adoption today. So it's been difficult at this point to measure success or see the potential benefit of the changes that the directive was looking to promote. Vote confirmations may be one area in which you could see the most benefit as we head into the proxy season early next year. Shareholder identification requests are currently following these guidelines as well. So you can see some of that information coming to fruition as well. Improvements in our notification timeliness and improved deadlines do allow investors additional time to weigh in on corporate events and make more informed decisions, while increased transparency may help promote further dialogue between issuers and their investors in order to enhance corporate governance programs. Thank you, Stefano.
Thank you, Tom. Thanks to you. Thank you for your very interesting presentation, update about Shareholder Rights Directive and number 2. So with the challenges that are still there, we're not yet there in many respects. Thank you
Correct.
also for illustrating the State Street efforts in that respect. As I said, State Street is one of the fundamental, crucial juncture between the various actors of the investment chain. And of course, your work is very important in transmitting information and not only being an intermediary, just a simple intermediary, because you intermediate many information that is absolutely essential for the good working of the investment chain. So thanks a lot, Tom. Very appreciated. Thank you very much for that. Now it's time to look also at the beginning of the whole chain, which is corporations, and we have the pleasure to have with us Giulia Balugani, Dr. Giulia Balugani, that is Sustainability Manager at Unipol Sai Insurances. Unipol Group is one of the largest insurances in Europe and is, I think, second largest in Italy. And Giulia has a specific expertise in the area of sustainability information and, of course, relationship with information intermediaries. So please, Giulia, thank you for being here. Thank you to Unipol for being here. The floor is yours.
Good afternoon to you all. Thank you, Professor Dambone, OIBR, for this speaking opportunity. So, as Unipol Group, and we can show the first slide, we have a double point of view, in fact, along the ESG information chain, because we are both a reporting company and an issuer, and we are even an investor. So, in fact, we were involved in providing information and integrating ESG information long before legal obligation took over. I can say we were early adopter in reporting with our first experience in 1993. That started from the belief that it was fundamental being transparent with our stakeholders, and that reporting would have been a great occasion of engagement. And in 2012, we adopted even a transparent methodology aimed at overseeing ESG risks and opportunities, issues and opportunities in the investment process. So we activated a portfolio screening based on compliance with the main international conventions, and we defined a set of exclusion, product-based and conduct-based. Then the norms arrived, and of course, we, in both scopes, we were committed to fully comply, but I think I can say in some way we tried to anticipate them. For example, we had our first integrated report 1 year before we had to be compliant with the NFDR directive in our integrated report. So, and we can go to the second and last slide. Today I will speak wearing the hat of the issuer of the company, because we had a very interesting speaker from investors, so from the other links of the chain. And I will touch shortly 2 main points that I summarized below. But I know that I won't be able to completely take off the hat of the investor. This is even because as a sustainability function in Unipol Group, we are deeply involved in the implementation of the sustainable finance evolution. For example, we are leading the internal working group set up to apply the 2088 regulation. So I can't forget speaking that we are also an investor. And I will probably let you perceive that there are some trade-offs that we have to manage, and how it's complex to satisfy both the extreme links in this chain. And I probably share with you more doubts than answers in having this double point of view. So, firstly, what are the challenges on reporting in this new regulatory scenario? For us as a reporting company, focal challenge, the first challenge is to understand firstly and then fulfill the expectations of our stakeholders in terms of information provided, and at the same time be able to effectively represent what are the characteristics of our company, of our business model. And of course, between stakeholders, investors and ESG rating agencies, regulators play a key role. And this challenge for Unipol is reflected in our integrated reporting that we draw up regarding a set of standards because we try to fulfill the expectation and at the same time to represent our model of share value creation. So we follow integrated reporting framework, disclosing how we work, how we invest in our capitals, in our intangible asset, which are our intangible asset, to generate value that is shared between company and stakeholders. And our outcomes are reported even according to the 3 SDGs we focus on. So we have even SDGs in this model. Then we follow GRI standards for our KPIs because we recognize that the value of being comparable, of course. And we follow TCFD recommendation because we know that how we are impacted by climate change and how we are acting about it is probably the first issue that it's interesting and concerning for our stakeholders. And we follow guidelines from EU commissions, both the general ones and the specific non-binding guidelines on climate reporting, because we think that double materiality perspective is fundamental, and we found that climate KPIs suggested by the EU Commission are very useful, and even we think that they will be binding probably in a while, so we are preparing. So in this way, we think we are giving a good representation of our share value creation model based on our materiality analysis. And we think we fulfill expectation. And it's easy to understand how it is expensive in terms of effort, in terms of resources. And it becomes more expensive year by year because expectation is growing fast and the model is complex. But if I put on the hat of the investor, I know that now they have in mind some new questions, adding to the traditional questions. Questions like, are you going to telling me how much you are taxonomy aligned? Are you disclosing some of the 32 KPIs that I'll probably be asked to report about my portfolio according to the ESA's 2088 regulatory technical standards? So investors now are requested by law to looking for highly standardized information. And preparing for this meeting, I did an exercise that I admit I haven't done before. I looked, till today, I looked to the 32 KPIs with the investor glasses, but now I went and checked how many of the 32 KPIs are clearly, expressly covered in my integrated report. And the answer is not 32 KPIs are covered, and more or less enough of them are reported. But I know that this depends mostly from the fact that a lot of them are not material for my sector and my company according to our materiality analysis. But the 2088 regulation in this moment seems not to be completely modeled on a sectoral materiality. It's a very standardized request for investors. So probably the investors would like to find a list of my 32 KPIs and filled in and just to have a very quick win information. And I have to think a way to provide them in my complex reporting model. So there is my share value creation model and the 32 very standardized KPIs. Of course, as a reporting company, we will work to keep both reporting needs in mind to answer effectively to both of them. We are going to work on models, on formats, on channels to be effective. We take the challenge not just because it is requested by law, but because as a long-time reporting company, we know very well that reporting is not just reporting at the end of a process, but reporting is a key step of a company's transformations process. And sometimes, or maybe frequently, is the reporting requirements are a trigger of evolution opportunities. So we are going this with conviction, right? With commitment, but it will be effort intensive, resource intensive, and not very easily matching with an objective of simplicity, if somebody has one. So I know that I shared something that was closer to a list of doubts that an answer. But just 2 minutes on the second point. So what's happening in the middle in the ESG information chain between issuer and investor? And we have some answers from the previous speakers. So I give my just my view. As an investor, as the other investor probably, I have an ESG rating provider that I choose because I think it's reliable in its analysis and it's able to follow my evolving needs. And I base my investment choices on the information that it provides me. But if I put on my issuer's hat,
Hello? Oh, sorry. I think Julia just had a little problem in connection. Hope most of you are there.
I'm still on, yep.
Okay, thanks. It was Julia having a little problem. Okay, so I think we can maybe get back to Julia, maybe later. We have just in time, is Patrizia Giangualano on? Sorry for this technical inconvenience. Patrizia, you there? Not sure. No. There are a few people that there's been a problem on the line, apparently. There's 20 people having problems. Christina, maybe. Christina, can you?
Yes, I'm here. Yes, yes. Patrizia just also announced me that she had a problem and the line was cut off.
Okay, apparently we had a mass cut off. But I hope that.
Okay, sorry, everything.
Okay, Julia.
Is fallen. Sorry.
Okay.
But just 1 minute. So I was telling that we received different rating for Unipol and Unipol Group, and we know that they are 80 or 90% the same thing. There are just some governance issues different. So I think this is an important point for the consistency and the strength of this ESG information chain. Different methodologies could be a tool for investors for defining the strategy, of course, but ESG data quality sees from an issuer perspective still shows a good margin of improvement. We know that EU is conscious of this, and because this point is touched upon in each survey on sustainable finance, and we think maybe some regulatory intervention is not so far, but today this is an open point and a delicate point. Sorry for the problems of.
Oh, sorry. I mean, sorry. We just sorry for you because you interrupted. Thank you also for raising the point of somehow the rating agencies and data providers that are, of course, not neutral. And of course, they can provide different opinions on basically very similar set of data, which is also a challenge probably for the ESG investment chain and information chain. Thank you, Julia, for that. I think we can move on now to our final speaker, and after, of course, we will have the conclusions by Cristina Ungureanu. The final speaker represents a very important point of view, of course. We all recognize that, the board point of view. Patrizia Giangualano is a board member of very important companies like Leonardo, Mondadori, and many others, a very long experience. She also belongs to the executive committee of Net Community, that is the Italian Independent Director Association. So she can represent very well, we think, the board's point of view, which is of course not an external agent, but is an internal agent, a component part of the investment chain. Patrizia, I hope you're there. You can.
Yes, yes. Did you see me?
Perfectly. Please, the floor.
Okay.
minutes.
Good evening to all. Thank you to Cristina and Stefano for this invitation. It's a pleasure for me to be here with you and give my opinion on the issue that you have just now discussed. As Stefano said, I'm a director of some medium and small large company. I have a long time experience in risk and control, and I'm a part of executive committee of NED Community. It's an association of independent directors very involved in the new governance practice and the sustainability matter, as the Italian self-auto-discipline code suggests. My point of view concerns the role of the governance in the new scenario and how a good governance can contribute to accelerate long-term vision and ESG accountability. In what way and how the governance can be implemented to reach this result. I would like to discuss with you three main issues regarding the governance. First of all, Board of Directors integrity and transparency are fundamental for the corporate governance system. Second, how the board have to explore the new scenario and what kind of organization and how involve the employees and speak about material teams with investors and other stakeholders, and in particular, the importance of the engagement. And at the end, I would like to speak with you about the review of the remuneration related to ESG. Related to the first issue, the integrity and transparency, in my opinion, must be I think that this issue is one of the principles that guide company in the outlining the corporate governance system. These points are very fundamental elements to review the company business model when it is necessary. In particular, the governance structure have to reflect the intention to integrate sustainability in its business model. And this issue, in this issue, the board play a central role in three things: in definition of sustainability policies and strategies, in the identification every year and in long term targets shared among function and subsidiary, and in verifying the related results, which are also presented to the shareholder meetings, but shared with other stakeholders. Related to the organization, I think that the governance to reach the result that I mentioned before and performance is sustainability duties need to understand and explore the future scenario. The boards can use different formulas for do this, but it's very important to dedicate time and effort to understand the context and study proposal on opportunity and risk related to the new environment. The board needs to have answer to different information related to the new ESG trends, to the investment that make the ESG impact, the issue related to the climate change in terms of transition and physical risk, the evolution of taxonomy, the new directive, the human rights, for example, issue related to inclusion, issue relating to decarbonization. But SDGs, as the other panelists say before me, the SDGs alignment is an important goal for the company that have to identify corporate KPI for entering the system environment. The board can decide to organize their governance in committee, for example, sustainability committee, governance and sustainability, risk and sustainability, innovation and sustainability, the new wave, a lot Some company now think that innovation is very important for the sustainability, and this committee are very clear and in some company. Or use external expert, organize in board advisor, or define new internal organization. But this is the scenario awareness and the financial consequences need to be explored and integrated in the business plan. This is an important safeguard for sustainability matters integrated in the company's business model and in a new strategy. The sustainability have to be cut across the corporate process and function, and the board needed to review the organizational and control structure to be sure that the risk and opportunity are correctly defined and the human resource are involved in this process. I think that related to the future and the role of the company that can have is an important imperative is the stakeholder engagement. In our opinion, depending from several surveys that we have done as association related to this matter, it's very important to involve the board in this work, because it's an opportunity to know directly the opinion of the main and most important stakeholder, and also understand if they are supporter or not. It's important for a board to know this. In this process, it's very important to define the list of stakeholders that we have to consider, the power and the influence that they have, and the engagement approach. Share the stakeholders list allows to be sure about the contact with the correct people. Large organization or government, regulatory stakeholder have many layers of bureaucracy, which can impact in a project delay. It's important found a way to communicate directly with the primary decision maker. It's also important, remember, that the stakeholder can be divided in different categories with different opinion about the material teams, and so it's important to know the upwards, the sidewards, the outwards, the downwards. So there are people that can help the company or not. Related to the influence, we need to know some answer to this question. How the interests overlap the project? What are their business goals, and how can the project interfere with them? Why is the stakeholder interested in the project? We can have a no good stakeholder engagement without understand each other viewpoints. Related to the power, each stakeholder has a unique ability. We have to understand that they have the ability to stop or change our project. We have to understand what is this ability, where does it derive from, and how can it and how it can be controlled. Sometimes the stakeholder power over the project can be removed, but it comes at a cost, both monetary and stakeholder satisfaction could become very unhappy and influence other stakeholders. But very fundamental is the engagement approach. The strategy for engagement the stakeholder must be defined in detail. The type and frequency of communication, the content of this communication, for example, weekly update about the project, progress about the project, design information, and other things. All these aspects needs to be defined in a policy. And it's important to develop a stakeholder engagement plan. I think that the plan is very important because if it's tailored to the side of the project and the area that we are following. For the large projects, such as a mining infrastructure transition project, stakeholder engagement is very fundamental. But another important thing is to discuss the plan in the company, not only in the headquarters, but with the project team, with the subsidiary, for approval before the implementation. When the plan in this action is important now, it's important to know the status and the opinion of each stakeholder, because the company needs the approval and the feedback to change. For projects that need it, detailed stakeholder engagement plans are fundamental. So, just to conclude this part, in that spirit, I will outline 3 steps to improve stakeholder engagement. Show the stakeholder you care, emphasize the human aspect, and give stakeholder a voice. At the end of my presentation, for the governance, as I said before, a last issue is related to the remuneration. To ensure that sustainability, the board needs to define guidelines, methods, tools, and managing the promotion sustainability matter through all function and all operating process. Related to this is necessary to study target set for manager with strategic responsibility, for example, related to transition versus new business model. Define the short-term variable incentive plan for CEO that needs to include environmental, social, and governance targets, and also analyze the long-term incentive plan that must provide a specific target on the environment, sustainability, and business model transition. For example, decarbonization, energy transition, circular economy, and others project will depend from the specific business. I think that to conclude in this difficult moment, the COVID moment, every board have to understand the new key factor and define a new target. It's difficult task, but it's important to reach new results from the investor and the people that work in organization. Thank you for your attention, and I'm here if you want for any questions.
Thank you, Patrizia. Thank you very much for your passionate presentation. Board members are not necessarily like you, frankly. There's been already a comment on your presentation in the chat, a very positive comment on you. So thank you very much for this vision of the world from the board perspective. All boards cannot call themselves out of this. They should be into this. And also, and this understanding and this awareness of the boards would help the whole investment chain. I think, and not only investment chain, not only investment, also the relationship with the stakeholder. So I think we can have about 10 minutes for questions and answers. I think there are a few questions that I noted to the speakers. First of all, they let me pose to Marina Iodice one question from Fulvio Rossi on can the standardized materiality analysis process be helpful in the future from an investor perspective? Of course, we live in the premise of that is that we live in an era of standardization for ESG information or tentative standardization. Charles Tilley before told us about the big efforts that are taking place, but also at the European level, there are other important efforts. So materiality becomes more and more important. And Fulvio Rossi posed the question to you, Marina, what do you think about the possibilities for a standardized materiality analysis processes? Would this be helpful for you? Thank you, Marina.
Thank you, Stefano, and thank you, Fulvio Rossi, for this question. It's a very good one because yes, I do think that standardized information about materiality would be helpful because different investors are defining materiality in a different way. Some investors only look at revenues deriving from the activities of the company that we are interested in. Other investors are defining it also taking into account research and development, or simply without quantification, just by looking at where the management of a company wants to grow. And I think if there's no standard in the definition of materiality, then when we report on impacts, also our reporting on that will definitely be differentiated. So in a nutshell, I do think that that is important, and I think that the regulation is also moving in that direction, in particular if I think about the EU taxonomy. Perhaps we don't have guidelines yet, but the intent is to make everything comparable. So we have to have the same standard for materiality as well.
Okay, thank you very much for this. Another question for Marina Pardini. I hope Marina is still there. We just heard that there are some limits in the ESG data from data providers. Why can you rely more on the internal information instead of data providers? If data providers are not enough reliable, what is your action? What is your behavior in this situation, Marina?
Thanks, Stefano. Yeah, of course, I think there are previous information that need to be taken by us directly, but it would be simply unfeasible to imagine imagining also the investments in infrastructure and resources that are needed to collect all these data. So I think that it would not be effective, and we will not have a better quality of data just by relying on internal information. I think that this should be an add-on. So starting from information from specialized teams, it is useful to add on that information that are gathered internally by looking at specific documentation, or by having a dialogue with company during the engagement process.
Okay, so basically investors should get more and more somehow equipped with their own teams to face certain lacks by the data providers. Is that basically the message?
Yes, I think that there is need for dedicated resources, human resources, and I've seen in a report of Russell Investment that went out recently that there is this increase. So I think that while some years ago there was this argument that the integration would bring ESG everywhere, but the analysts will be fundamental analysts. There has been a recognition that there is the need for dedicated people on ESG.
Thank you, Marina. Tom, you still on? I have a question for you.
Yes, I am.
Yes, Tom. So, I mean, what is the biggest challenge you think or surprise in implementation of Shareholder Rights Directive #2? What, in your experience from a State Street Bank experience, what has been the biggest challenge or surprise in implementing this new law in Europe?
Yeah, I think it was a couple of different things. To be honest with you, I think it was the fact that not everyone, not all the intermediaries in the chain were 100% ready for the directive on September 3rd. I think that there was some thought process that maybe the directive may have been delayed due to COVID-19. That never materialized, so I think there was a rush for intermediaries to make sure that they solutioned for the directive. So that's one of the areas. And the second one is I do a lot of client presentations, and I think there was a general lack of awareness of the directive I think most thought it was a European directive, but clearly, you know, in the US and in other geographical regions, if you were, you know, if you invested in a security in the EEA or European Union, you are bound by the directive. And I think there was that, you know, lack of knowledge, if you will. So it was our goal to kind of bring them up to speed as quickly as possible through communication.
Okay, Tom, thank you for this. Thank you for being here. Just the two general questions. We have a really couple of minutes, no more. General questions that arrived. One is about ESG for SMEs. We know that in Europe and in Italy especially, SMEs are really the backbone of the economy. And can you perhaps suggest us, can you see some driver for ESG for SMEs to convert from a purely financial culture to an ESG culture? And a more general, the second general question to all the panelists, from a consultant that says, I would like to work in this world more and more. Do you have any suggestions? So it's a bit of a general question for that. So who wants to take up on this? SMEs on one side going to ESG, towards ESG culture, and suggestion for a consultant that would like to work more and more in this environment. Patricia, maybe? Yeah, Patricia.
I would like to answer to the ESG, because to the SDGs, sorry, because I think that the company are doing a very effort related to this data, because it's not easy to identify KPI for company related to this matter. So they are trying to individuate some good KPI that can be that can stay in a system, and I think it's a very big effort, and we have to appreciate this opportunity that they are doing. Thank you.
Thank you very much, Patrizia. Can somebody close the microphone? I think there's a little bit of noise. Some suggestion for the consultant that will, you know, got fascinated by this field before moving to Christina, that has to sum up in 5 minutes for sum up. My personal suggestion to the consultant is that to follow our webinars, which sounds a little bit like an advertisement, but we think that clearly there's a need to create a culture on this. We will focus more and more on these issues. Like should be the first webinar of a series. So I hope that this consultant can contact me and maybe we can have a private chat on this.
If I may, Stefano, I would add that there are also public resources like MCI ESG as a website where you can look for a fund or an index and have some information. There are general information, but there are also some indicators that are also foreseen in the regulation. And also Morningstar can be another tool. Or URSRI, there are several platforms that cannot be used in aggregate level. So for instance, when we look and screen for all the data, we cannot use them. But if you have some specific portfolios or funds that you would like to have more information on the ESG perspective, can be useful. I hope that.
Thank you, Marina. I will give the final word then to Cristina Ungureanu, and I would like also to thank her publicly for her big effort in organizing this webinar that I think has been quite original and quite interesting from a different perspective that he has offered. Cristina, The floor is yours. Drive us to the conclusions, please. Thank you.
Absolutely. Thank you, Stefano, for a very unique discussion. And thanks to all speakers for their view and role in improving corporate communication. We had various players during today's discussion. We had the issuer company, we had investors with different investment strategies, we had the intermediary, and we had, of course, the independent board director. So it is clear to me that all actors, and of course there are several others such as auditors and regulators, we'll certainly have another session also with them. It is clear that all these actors in the corporate reporting ecosystem have a part to play, be it management, the people charged with governance, investors, intermediaries, auditors, regulators, they all need to act in concert though. And at speed to deal with some of the challenges we face, which are both practical and technical. I believe that we all acknowledge after hearing the presentations that reporting is an opportunity besides a challenge, certainly for the company, for the issuer company, in order to inform its strategy to internal and external stakeholders through shared value creation. Julia Balugani from Unipol has certainly pointed that out in her presentation. Reporting is also an opportunity for us investors to improve the portfolio ESG performance and certainly the related investment returns. Dealing with such a myriad of standards and frameworks and regulations, companies will have to first identify their key stakeholders in order to embark in the reporting exercise. And in this regard, the concept of materiality is essential, we heard. It also helps to build the path for company sustainable strategy. And also Charles Tilly in his introductory speak has highlighted the importance of materiality, and it transpired also from all presentations today, also from Fulvio's questions in the audience. In this regard, governance has a major role to play, has a major responsibility. There needs to be appropriate challenge from the board, also around building corporate reporting. And we heard from Patrizia Giangualano about the essential role of directors in directing companies towards achieving an appropriate reporting towards all stakeholder categories. Then moving to investors, without a doubt, investors have a very important role to play to steer companies towards better communication. The role of investor is certainly capital deployment, which actually needs to be based on informed decisions. As we go forward into rebuilding our economies, it is important to renew the focus on the investor call for a reporting regime that is centered on what is relevant for the long-term sustainable value creation. And for Eurozone Capital, for example, the asset manager I'm proudly representing, being one of the largest European asset manager, we have a very high responsibility in our investment strategies. This concept of long-term sustainability value creation is actually the main drive also of our global investment decisions. As investors, we understand that we expect issuer companies to get the balance right. It's a balance between the timeliness of reporting while ensuring also its integrity, insightfulness of reporting. So we need to get the information in a timely manner in order to know whether companies are able to manage from the current stage to the next stage. In the same time, trustworthiness is crucial for us investors. Engagement is another concept. Engagement between investors and companies is a key factor, and this has been highlighted in the presentations by Marina Jodice from NN Investment Partners, also by Marina Pardini from Banco Posta Fondi, but also the engagement with other stakeholders, as Patrizia very well underlined. This is in order to further contextualize the reporting within the company's own environment. Not least the role of information and technology for facilitating the communication between companies and investors is obviously becoming ever more important, particularly now due to the challenges imposed by COVID crisis. So intermediaries such as depository banks have a very important role in order to facilitate the flow of information from companies to investors. And specifically now with the adoption of the Shareholder Rights Directive 2, intermediaries, we heard, are set to help market players to deliver a global communication experience. Around this activity, we had the testimonial from Tom from State Street, from Tom Broderick. And I strongly believe, and I want to emphasize this importance of information and technology. I strongly believe that the advances in technology will be an opportunity for all of us market players, for companies, intermediaries, investors, regulators, to improve and to further evolve the communication and interactions. So as a conclusion from what we heard today, I really believe that we all market players need to see reporting, need to see transparency through the investment chain as an opportunity to communicate. I'm very much encouraged by the substantial momentum towards a system-wide solution for corporate reporting that will certainly meet the expectations of investors and also the expectations of wider stakeholders categories. Thank you very much to everybody and for the organization and to everybody involved, also for their passion in the presentations as we all heard. Thank you so much.
Thank you, Christina. Thanks to you, and to the next occasion with an OIBR webinar. We want to keep on doing this, and with Christina, of course, all the friends. And thank you very much for your participation. The whole session is recorded and will be put in YouTube. And remember also that on the 1st of December, OIBR Foundation will offer, will manage a session in the international conference on the international conference on the integrated reporting on the 1st December 15:30, and there will be the president of Generali, the president of Enel, the consob, the top level, will be involved to talk about the situation in Italy, about non-financial information and integrated reporting. And I think that will be another occasion, but we will write to you, of course, to let you know how to get into this session. Thank you, Christina, again. Thank you, IRC. Thank you to all of you for your participation in this webinar.